I am once again delighted to welcome back the great Lyn Alden. Lyn, welcome back to Forward Guidance.
Thanks for having me. I'm recovering from a certain well-known virus, so hopefully my symptoms don't interfere too much with our chat, but happy to be back.
Oh yeah, we are thrilled to have you here. When we first had you in October, the narrative was very clear. The yield curve was flattening, perhaps growth was slowing. The team transitory was very strong. In the new year, Lyn, we are recording this on Wednesday, January 19th. The market is sending an extremely clear signal with all sorts of bonds all across the curve selling off. The yield curve still flattening, an epic rotation from growth to value. Inflation is still red hot. In the U.S., it was 7%, as we learned last week. And as we learned today on the 19th, in Britain, UK inflation topped 5.4%. Oh, did I mention that oil is at $89 a barrel, a 7-year high? So much to talk about. Can you just walk us through how you're sort of thinking about this market?
Yes, I think overall, basically, I think the high inflation theme that's a lot stickier than a lot of people thought, combined with the fact that central banks are now at least around the margins, trying to deal with it. They can't completely ignore it anymore. They can't write it off as totally transitory. And so the fact that they're fighting back, I think, represents a new market regime that we have to respond to. And so I think that the past 2 years of heavy stimulus, pretty much all assets going straight up, I think is kind of fading into the rearview mirror to some extent. And now we have to look a little bit more cautiously and a little bit more sector specific. Back during when the vaccines were announced in late 2020, you had some rather epic rotations and different factors in the market because that gave us new informational value that changed a lot. And I think we're seeing a somewhat similar dynamic now, but not in terms of accelerated growth. If anything, growth is cooling off. But basically, it can change the rate situation, how much money's flowing into asset prices. So I think there are a lot of new information to digest as any sort of position trader or even long-term investors. When we look over the 2020s decade, I'm more bullish on many commodities and commodity producers than I am, say, the S&P 500. Now, there still can be periods where that's overdone. And so for right now, for example, we're in kind of a decelerating growth period, less fiscal stimulus, and so I'm not really pounding the table on many types of commodities right now. But I do think that wage inflation is somewhat sticky. I think that longer term energy inflation is somewhat sticky. I do like the energy transporters because they're less price sensitive. They're paying very high yields. They're very low valuation. I like some of the more value oriented defensive sectors like healthcare. And I think we can start picking through some of the rubble of some of these ARK and ARK-like type of growth stocks. Look for bottoming opportunities there and in emerging markets. So I think I would characterize that I think we're in a more choppy sideways type of environment than we have been over the past couple of years, especially in U.S. markets. I'd be very cautious because I think some of the very large fund flows that just piled into U.S. growth equities are maybe behind us, and that could resolve with a correction. That could resolve with a big choppy sideways period. I don't know. That depends on a lot of factors that are hard to predict. But I don't really love the risk reward ratio there, at least for many of those names. And I find that focusing on dividends, focusing on high quality value is useful here. I think Bitcoin is in a consolidation, but I think the fact that it held up better than a lot of the things it's correlated with, some of the high beta stuff that's correlated with, I think that's constructive for it, looking out over the longer term. And I also think that we have to start looking at gold to see if gold is trying to, maybe break out a little bit. So I think that there are a bunch of things outside of say, the S&P 500 and the NASDAQ that I think are more interesting to the upside or at least protecting from maybe severity of losses than being very, very overweight in those big U.S. indices.
Right. So there's the level of the absolute index, S&P 500, NASDAQ. S&P 500 is about 5% off its all-time highs now, but that doesn't come anywhere close to showing the chaos, the roiling in the markets where money's flowing out of one sector and into another. And in this case, it would be out of technology stocks and into energy. We can put up a chart of the S&P 500 SPDR sectors, and almost every single sector, I think, is down except for energies and financials. And the difference in performance is just stark, with energy up something like 15% and technology down something like 7%. And if you replace the XLK technology ETF with ARK, it's somewhere like a 33% relative alpha difference, and we're only 20 days into the year.
No, it's one of those things. Those rotations can happen very quickly, and I think one of the things that really caught a lot of analysts off guard is they're not paying attention to the supply situation in energy. A lot of people like to have their models, and models are useful, but it's one of those, the old phrase like all models are wrong, some are useful. And so a lot of people have these models that say, okay, if economic growth is slowing, energy prices have to go down. And so that's not necessarily the case because you can have other areas that are accelerating the market. And then two, it's not just about demand, it's about supply. And we've been in this, during the whole growth of the shale sector over the past decade. That introduced a very novel variable into global energy markets. And now, I'm not saying that shale is going to go away. It's just that whole growth phase from a very small base into a very mature industry is more or less over now. And so that's now part of the energy market. And so as the world comes out of the pandemic, as the world comes out of Omicron, it has rather substantial energy demands. And the combination of OPEC was rather disciplined, and then some even suggest that OPEC has less spare capacity than they're letting on. Some of the countries have been failing to meet their production targets, combined with the fact that investors are not plowing a lot of money into shale. Shale companies being rather disciplined, and they have rather rapid decline rates. I mean, it's already United States is already the biggest oil producer. There's only so much more energy that can be brought online. And so basically the overall market is a lot tighter than it was before, and that does have implications for inflation expectations, rates, growth, equity valuations, and all these other variables. Generally, over the long run, commodities go through these really big cycles, and a lot of these periods of major growth outperformance. So, for example, the 1960s, the late 90s, and then over the past decade, the whole 2010s and going into the COVID era, these were characterized by suppressed commodity prices, periods of commodity oversupply, including particularly energy oversupply, and during that period, people get into their mindset that, oh, we're post scarcity now. We have no commodity constraints. It's all about growth. It's all about whatever the new thing is. Like it was software. Before that, it was the internet. Before then, it was other types of growth companies back in the 60s. And it's like, okay, it's a new paradigm now. But what happens is eventually, supply gets tighter, and you start running into supply-demand imbalances, and now kind of those shortages are reasserting themselves, and I think questioning the whole kind of growth over value dynamic.
Yeah, in that era of secular inflation that you see, Lyn, commodities do well. What happens to the stocks that have traded at very high multiples, but one could say have deserved those multiples, whether it's Microsoft or Apple, or I believe you did an analysis of Costco where there are network effects. People like to show up to Costco, and they've been able to grow their earnings at a fantastic clip. What happens to those sort of, quote, high quality growth companies in the era of high inflation that you see?
Generally, it's rather weak for them. And so Costco's a wonderful company. From an investor standpoint, they've also, they had a long pattern of treating their employees better than many of their retail peers. So, in areas that I would consider like the true ESG scores, they're one of the better companies out there. So I have nothing against Costco. The challenge is that over the past decade, as good as the fundamentals on Costco were, the stock price did even better. So it went from something like 25 times earnings to over 40 times earnings. And that's rather rich considering their forward growth expectations, especially if they do run into more cost pressures, and especially if interest rates don't keep going down. And so they benefited from a constant period of long duration yields going down, which allows you to raise you can lower the discount rate on your valuation model and jack up the valuation on your equities. They also benefited from a tax cut that's probably not going to come again. And they had other secular headwinds. And so I do think that the Costco is going to continue to grow as a company. The question is whether or not the investment will do well in, say, inflation-adjusted returns compared to other alternatives out there. And so if you look back historically, I mean, in the 1960s, for example, there was the idea of the Nifty 50. There are these 50 companies that you could buy, and you had almost no chance of losing money. That was the theme of the time. These were tremendous growth companies. A lot of them we know today. They were like Disney, Coca-Cola, American Express. Xerox, obviously, they had a great run. Sears, which is now, it didn't do well, but during the whole, the whole 20th century, that was a powerhouse. And you had these ideas of these, like, untouchable companies. And the analysis was right. The vast majority of those 50 companies did go on to do tremendously over the next several decades. But the majority of them were also bad investments for a 10 to 15 year period because they ran into high inflation. Their multiples were too high. And so it took, like, 10 plus years for their fundamentals to catch up to their valuations. If you look back to the dot-com bubble, a similar thing happened. I mean, everybody thinks about the tech stocks, but if you looked at companies like Walmart and Coca-Cola, they actually got to extraordinarily high multiples. And again, their fundamentals kept growing. Their earnings per share kept growing after that point, but their stocks went to stagnant for over a decade as those fundamentals had to catch up to their valuations. And so I think we're in a similar dynamic for some companies today. Maybe it might not take 10 years, it could take 5 years, right? It's hard to say exactly how long these things take. And it's not even necessarily forecasting negative returns. You can go sideways. Corrections can roll out sideways instead of down. Basically, you can either correct in time or price, and so you can go sideways as all those fundamentals catch up. And so I think that there are a number of securities out there, especially some of the mega caps, that are at risk of that sort of catch up game where they might not provide very good inflation adjusted returns over a 5 year stretch.
I want to really get into the mechanism of correction of valuation. So let's take a stock like Chipotle, which I believe trades at something like a 50 price to earnings ratio. That's what you say when you say valuations. That's the multiple. And if it were to compress to 25, the stock would get cut in half, assuming that earnings stay level. So you're saying the inflation, what really killed the Nifty 50 stocks was inflation of the 1970s. My question was it the inflation itself directly, or was it the fact that bond yields surged in order to meet the inflation? Because if inflation is 10%, you can't be getting 2% on your money. Then you're losing money in real terms at 8% per year. And also, so is that the mechanism? Is it rates? Is it long-term rates that affect the discount rate? And my follow-up question would be, what if discount rates stay low? And as we have seen over the past year, inflation is red hot at 6, 7, even 8%, but bond yields stay low. Is that going to be like dynamite for all stocks because the economy is running super hot and bond yields are low? Or do you also expect that to be bad for growth stocks?
So that's a fantastic question, and I would say the answer is somewhere in the middle based on the data that I've analyzed. And so I think the reason why it was so bad in the 70s, like that was a particularly bad stretch for inflation-adjusted returns, and I think a lot of that was the fact that rates came up so high to deal with that inflation. That was a different kind of inflation that we're dealing with today, right? So that was bank lending-driven inflation combined with some fiscal deficits. There was a big demographics bulge, plus you had the energy shortages. You had to rely more on the Middle East for your energy. U.S. oil production peaked for a multi-decade stretch starting in 1970, going all the way to the beginning of the shale, revolution, several decades later. And so the fact that rates went up so high put a ton of pressure on valuations. And so it's natural to think that the rates are the key thing there. However, if you go back and look at the 1940s, which viewers will know is the era that I find more instructive for this environment than the 70s, you had rates stay relatively low even as inflation had these multiple spikes, these periods of running hot. And yet there actually still was a growth to value rotation during the 1940s. And that was just a kind of a different era in general. Valuations started and ended that decade lower than they are now because you had all the uncertainty around the war. You just came out of a very long depression. You're still kind of in the depression in many ways, and so that was a very different era. But the point is that despite having high inflation, low yields, you still had somewhat of a rotation. And one way I think we can describe it today is that if yields simply stop going down, right? So if they just start going sideways in a macro sense, that takes away a really big headwind that is kind of piled into growth equities. And so I would say that if the valuations just kind of stop widening, the fact that value stocks generally pay higher dividend yields, many of them are at average or even mildly below average valuations, that allows for kind of a period of catch up. So if yields don't go up tremendously, it might not be as explosive of a reversal over the longer term. Like you might not have growth stocks do abysmal, you might not have value stocks soar, for example, and that has implications for the financial sector and things like that. But you can still have a some degree of a growth to value rotation in a more inflationary environment, even if yields stay say negative real territory, and if they just kind of go sideways or maybe go up a little bit or just kind of keep grinding around at these levels. I think the fact that if the 40-year bond bull market is maybe not over, but maybe we're in the picking nickels up in front of a steamroller phase, right? So maybe it's we're we're kind of we squeeze a lot of juice out of that orange. I think that's what starts giving us more capability from the value sector, and a lot of it can simply come from the dividends. I mean, if you look at so for example, energy pipelines, many of them are paying 5, 6, 7, 8% yields that are actually rather sustainable based on their current fundamentals. You know, they just have to go sideways, and if they go sideways, they can actually outperform a growth stock that goes sideways that pays no dividends, right? So I think that's the kind of environment that we might be looking at.
What sort of sectors other than energy are you interested in at this juncture that are valued? So energy is kind of the poster child for value because historically it's had so many problems. But there's banks, there's industrials. What other sort of sectors or styles or stocks catching your eye?
So it's a good question because and as much as I like energy, whenever I see such a positive divergence, the contrarian in me is thinking, once everyone's on one side of the boat, so I get concerned. So I think we can separate time frames. So I'm a little bit maybe more cautious on energy here than I was last year, while still having a constructive view over the course of the next 5, 10 years. We look at other sectors. I think defensive value is interesting. And so I think the healthcare sector, especially, when people think of healthcare these days, they often think of the vaccine plays. That's been a very big theme over the past couple of years. But I'm talking about just other areas of healthcare. So pharmaceuticals, insurance, health insurance. I think some of those are rather appropriately priced. Some of them pay decent dividends and they have decent growth forecasts. And so overall, I think that's an area that is still, has basically good risk reward fundamentals in it. As much as I don't like tobacco stocks, I think some of them are well positioned here. Again, they pay super high yield. They can just go sideways and potentially outperform some of the heavy kind of highly valued growth equities out there. And so I do think that there are other sectors like that, kind of the defensive value type of categories. Um, when we look at industrials and some of this more cyclical value, I think that they could run into some choppiness for a period of time here because we're going through kind of a period of global deceleration from so much stimulus. We're kind of sorting out what the world's going to look like in a year or two. And so I'm not necessarily like pounding the table on those, but I do think that those are probably pretty well positioned over the long run as well.
Mm. The rising of bond yield and the compression of valuations is one of the four factors that you think has fueled the bull market in U.S. stocks, not just over the past 10 years, but over the past 40. What are the other three, namely tax cuts, passive, and the sort of dollar recycling system? Can you walk us through that? And then I want to get in depth on the dollar.
So in the United States, we've had a large series of tax cuts, and a lot of people look at headline tax rate, which actually doesn't change that often. I mean, it changed under the Trump administration, but prior to that, it didn't change for a while. But if you look at effective tax rates, those are the tax rates that really matter. That's what you pay at the end of the day. And so if the headline tax does not change, but various deductions or you can call them loopholes, if those things change, you can pay more or less taxes. And so if you chart U.S. corporate tax rates over the past several decades, it's been this pretty persistent downtrend in corporate tax rates. And if you look at, for example, where tax revenue comes from as a percentage of total tax revenue, it's really shifted from corporate tax rates to payroll tax rates. And this had a couple implications. One, obviously, we shifted less partially from companies onto workers, but then also we have to keep in mind that employers, those companies also pay payroll taxes, but the ones that pay more of them are the labor intensive ones, right? So the big beneficiaries are the very labor light companies, software, financials, some types of healthcare companies. These companies generally they earn a lot of money without having a lot of American workers, and so they benefit from cutting corporate tax rates on profit. Even if their payroll taxes are still kind of going up. Whereas if you're a company that employs hundreds of thousands of people, especially relative to the size of your revenue, those payroll taxes are more important. And so I think one of the trends to watch out for is that kind of structural downtrend of corporate tax rates is probably behind us. I don't know if we're going up, but I think we're probably at least kind of in the realm of trending sideways now. If you look at how low it is, I mean, it's the effective tax rates are quite low, and so I think that's bound to go sideways for a period of time, and that takes away one of the headwinds, one of the tailwinds, I mean, both for the entire corporate equity market, but then especially for the very labor light companies that have really kind of benefited from that. Another big kind of overall tailwind for U.S. equity markets was the structural U.S. trade deficit. And so, ever since we kind of created the petrodollar in the mid 70s, it's just this whole idea where most oil producers will only sell their oil in dollars, no matter what country's buying them, right? So if France or Japan wants to buy oil from Saudi Arabia, they're paying in dollars. And by extension, the implication of that is that every country that needs to import energy needs dollars. And so they can either exchange their currency for dollars or they can start selling their own exports for dollars. And then on top of that, we layered the Eurodollar system, all the debt markets. And so the dollar became the major funding currency. So entities around the world borrow in dollars, not really often from the United States. They're often borrowing dollars from Europe. They're borrowing dollars from China. And so just because they owe dollars doesn't mean they owe them to the United States. The United States is a net debtor. Many of these other countries are net creditors. But the point is it's denominated in dollars. And so the combination of needing to buy energy in dollars, most commodities in dollars, and having debts repayable in dollars has made the dollar the reserve currency. And by extension, all these countries are gathering all these dollars. It kind of strengthens the dollar relative to what it would otherwise be on a trade weighted basis. And so it basically forces the U.S. to run these big trade deficits. Basically makes our imports power very strong, and it makes our exports less competitive. And so basically all these dollars flood into the world, and they need to do something with them. They used to put them in our treasuries, but as yields came down, now they're below inflation rate. We started to see these large sovereign wealth funds, these large pension funds, these large pools of foreign capital go into buying large amounts of U.S. equities. They buy U.S. real estate, they buy U.S. corporate bonds, and they buy wholly owned U.S. subsidiaries, for example. And so we've had this period where a lot of capital is kind of poured into the United States, but it's come at the cost. I mean, it's obviously come at the cost of these structural trade deficits, and that can result in all sorts of, rising wealth concentration, economic dislocations, and problems like that. Because, as much as that benefits the U.S. stock market, the problem is that, 89% of the U.S. stock market is owned by the top 10% of households. And so the bottom 90% of the population dealt with most of the consequences of having a structural trade deficit, but got fewer of the benefits, while the top 10% had almost none of the consequences of a structural trade deficit and got almost all of the rewards from it. And so basically with so much capital kind of piled into U.S. growth equities, while the U.S., as an economy is not necessarily benefiting from that arrangement. More politicians are, I think, becoming aware of that dynamic. They're not, that's been somewhat bipartisan. I mean, that was obviously a big theme of under the Trump administration. So he started talking about the trade deficit quite often. He didn't fix it, but he started pointing to that problem. And so I think it's one of those things that's going to get more airplay going forward, and it kind of presents somewhat of a headwind, I think, going forward, in terms of how much higher, how much more percentage of the global equity market that the U.S. market can capture.
Right. So the dollar system that you talk about, everyone needs dollars because they use it for trade. If France is going to buy coffee from Ghana, they're probably going to buy it in dollars. And if the Ghanaian, farm wants to build it out, they're probably going to borrow in dollars. And they may not borrow from a U.S. bank. They could borrow from a Chinese bank. So there's a ravenous appetite for dollars that has allowed the U.S. dollar to run a structural trade deficit, meaning that it imports more than it exports.
Yeah, and it not just allowed it, it basically forced it. That's the key variable to think about is basically that's one of the costs of having that system. And so that benefited a lot of people, but it also hurt a lot of people. And it's not just allowed us to, it kind of forced us to. But go ahead. Yeah.
Yeah. So that is the trade channel. So there's end up being a huge amount of surplus dollars, but that is recycled back via the investment channel. So they're buying U.S. Treasuries, they're buying U.S. equities, and that has been a buoy not just for bonds, but also for U.S. stocks. My question, Lyn, is why do you think that is going to change this sort of 40-year trend, the petrodollar system used because that's dollars were first used to denominate barrels of oil? Why do you think that's going to change? Isn't it? I may be wrong about this, but isn't it true that the U.S. trade deficit actually widened because we're importing more and exporting less over the past year?
Yes, during the whole like pandemic period, and that was in large part because the U.S. did a lot of fiscal stimulus that boosted our consumption without boosting our production, and so other countries kind of met that production. I think going forward, as U.S. domestic fiscal stimulus subsides, that will damage some of our consumption acceleration, right? And I think China, they were tightening over the past year. Now they're in at least a mildly stimulatory move. I'm not very optimistic on their real estate sector, but I think some of their other areas could accelerate out of the stagnation that they've been in. And so I think going forward, it's not that I think the U.S. trade deficit is going away anytime soon, but basically I think that this giant engine that's been kind of fueling it and then piling capital back into U.S. capital markets is slowing down. We're also seeing around the margins, some foreign markets are starting to price oil outside of the dollar-based system. And there's a lot of incentives for that. So obviously China wants to they want to internationalize their currency to a greater extent. They want to launch a central bank digital currency. They want to be able to go around the SWIFT system. Same thing for Russia. Russia's been aggressively de-dollarizing. They've been, wanting to sell their exports in euros, sell their exports in yuan. Make deals with India that is in many ways a U.S. ally, but still willing to deal with Russia and go outside the dollar-based system. They're focusing on increasing their bilateral trade, and so I think we're seeing a more diverse global currency market going forward, where the dollar is still very important, but it has less of a total lock on global commodity markets going forward. And so I think that's the trend shift to watch. That it's not absolute levels that tend to matter for markets, it's rate of change terms. And so I think that the dollar is still going to be very critical, but that once you start pricing commodities on the margin in other currencies, and start, even some cases funding debt in other currencies, that starts changing the rate that this whole thing that operates at. And when you already have very high U.S. equity valuations compared to foreign markets, I think that starts to look heavy at those levels. Basically, it needs more and more capital inflows just to maintain kind of the rate you got to, and kind of keep it going up with low volatility the way it has been, right? So I think it's that around the margins is where it matters.
And in that world where less marginal capital is flowing into the capital count of the U.S., what does that mean for the absolute level of the dollar, whether it's the DXY relative to the yen, the euro, or emerging market currencies? And also, what sort of assets perform in that environment? Is it inherently a reflationary environment, one in which the dollar does poorly?
So overall, if that trend were to happen, that should be weaker for the dollar. That should be more reflationary. That should be positive for several types of emerging markets, especially ones that tend to be a little bit more commodity oriented. And so that's, I think, a general trend to look out for over the 2020s decade. I don't think it'll be a straight line. Generally, when we see periods where the dollar becomes overbought on the weekly chart and then rolls over into negative momentum, it's not a perfect signal, but I think it's one to watch because generally when that happens, more often than not, that has tended to resulted in a pretty significant and longer duration kind of, more often than not, it's a decline in the dollar relative to other currencies. Sometimes, the dollar still stays heavy. I mean, it still stays strong, but maybe it stops going up at the same speed that it has been before. So it can kind of slow down. And so I think that's something to watch going forward. One thing I would point out is that gold has a pretty strong inverse correlation with real rates. And we've had this pretty strong jump recently in real rates, and gold really shrugged it off. There was a period of time over the past 12 to 18 months where things that should be good news for the gold market didn't really move it. And now we're starting to see things that should be kind of bad news for the gold market not really move it. And that tends to be a pretty bullish sign. And so I think aspects of the market are starting to maybe sniff out that I think the dollar could run into a little bit more headwinds going forward. But it's we have to watch the price signals because we can do all the fundamental analysis, we can put the pieces together, but we have to start seeing if price confirms it because that starts to point to are there variables that we're missing? Is it starting to go the way we expect, or do we have to go back and reassess? So I'm not like calling a super high conviction statement that the dollar's going down now, but I've observed a couple patterns here. I think that a lot of the dollars have been bid because people are piling into the U.S. growth markets, and so I think that if that starts to unwind, or at least if it stops accelerating the way it has been, I think that could start putting pressure on the dollar.
So you think that a series of underperformance in U.S. equity markets, particularly growth, could be very bad for the dollar. That's interesting because typically on an intraday basis or a one-day return basis, days where stocks sell off and commodities plunge is typically very good for the dollar, right? But you're thinking on a longer-term basis.
Yes, and I also think if you look at sector rotations, and so for example, the 2000s decade was a weak decade for the dollar. You came off the big high that went into the dot-com bubble, and what did well? Value equities, right? So banks, real estate, energy, those markets did very well during the 2000s decade with a weaker dollar. Then if you go back to the 70s. What did well? And we had the dollar came off the Bretton Woods system. That was a weak decade for the dollar. And basically, energy did very well. And the Nifty 50 stocks, all those growth companies, are the ones that struggled the most. And so, the dollar, we've had this inverse correlation where, the markets go up when the dollar goes down and vice versa. But if you have I think a more structural rotation where a lot of capital just stops piling into, say, the big growth mega caps and starts being more picky towards some of the more value-oriented sectors. I think, yeah, basically you could have a weaker dollar, you could have a weaker broad indice, but you still have attractive sectors that are doing well. And I think that could also buoy some of the international equities that are their indices tend to be more value weighted.
You note that you're becoming less bullish on U.S. equity indices. And that makes sense because so much of the index is now comprised of these mega cap growth names as well as smaller cap growth names. What is your outlook on the indices, whether it's S&P 500, SPY, or the NASDAQ 100?
So there's, if you map out like, Wall Street end of year targets for the S&P 500, it has almost no correlation with what the S&P 500 does that year. So I try to avoid those specific price targets because I'm not any better of a soothsayer than any of those others. So instead of speaking kind of price terms, I think in overall just what do I expect overall? And in general, I'm not necessarily calling for a crash. We could have one, I don't know. But it just generally when you add a couple of these things together, so when the Fed balance sheet stops increasing, ever since the global financial crisis, that's been pretty challenging for indices to keep going up. The big exception was during 2017 when you had, massive corporate tax cuts, right? So we either need generally monetary stimulus or fiscal stimulus to keep the equity markets in the U.S. going up at least at the rate that they do during those big bull stretches. And so that seems to be kind of in the rear view mirror now, and now we're getting to a tighter period for central bank balance sheets as well as for fiscal stimulus. So that's a variable to watch. Two, when you look at the purchasing managers indices rolling over, that's generally not a very constructive environment for the equity indices. Then you can look at things like the copper to gold ratio. Basically, a lot of confirming indicators suggest that we're maybe not in a strong phase for U.S. equity indices. Now, the funny thing is, you could still actually have a positive year or a positive 2 years. But I would say that even if that happens, you'd probably, I don't think we're going to get the growth that we had over the past 2 years, right? So I don't think it's going to be a straight line up. You could eke out a positive year, but I think it would be a weaker year. Now, or you could have a negative year, you could have a very negative year, you could have a flat year. But overall, I don't really love the risk reward ratio for U.S. equity indices, over the next 12 to 18 months.
So those are the negatives. Fiscal drag, Fed, you'll be fighting the Fed by going long equities, Federal Reserve tightening, copper to gold ratio rolling over, PMIs rolling over, all the dollar thing that you're talking about. Those are the negatives for the equity indices. What would you say are the positives?
So the positives would be that, the market aggressively priced in Fed tightening already. And if we start to get any sort of dovish surprises at all, if because I actually think, even though I've generally been on the inflation camp for a while, I am looking for a potential top in year-over-year headline CPI, potentially by the end of the first quarter of 2022, maybe the second quarter. But I think that the year-over-year is starting to get heavy, and that we're entering a period of at least relative disinflation. It's still it's disinflation if we get that from a very high level, and there actually are risks to that view. I mean, if energy absolutely spikes, then that might not happen, right? But as long as energy doesn't go crazy, I can see that inflation starts to get kind of heavy, and so the Fed would be tightening into a growth slowing and inflation decelerating environment. So that's obviously bad for indices, but if they have that dovish surprise, that could give growth stocks another little leg up, right? So I think that even though I like value more than growth, I think there will be periods of time where everybody's on one side of the boat in the near term. Everyone's like screaming value, growth to value. Everyone's screaming energy, and then it's like, well, I mean, that's actually when maybe you want to even buy the long end of the bond curve. Maybe you want to go and buy some of those oversold ARK stocks, for example. I think there will be periods where some of them can do pretty well, um, and so I tend to fade when sentiment gets very extreme in say the short to intermediate term. So I think those are kind of the key things to watch. Basically, the more supply chain normalization you get, which I don't think is coming right away, but I think around the margins we're starting to see that, and the more disinflationary pressures you get, it could help the growth stocks to some extent. But overall, I think it's a challenging environment for the very growth oriented indices.
How serious of a threat to stocks and risk assets is the Fed's tightening, our global central banks tightening? What do you see as a greater threat? The taper and quantitative tightening rolling down, letting the balance sheet roll over, or is it hiking rates? And will either of those two channels of monetary policy tightening, will they be effective in fighting inflation at all, or will the topping in inflation that you see in late Q1, early Q2 be due mostly to supply chain and not really have to do with the Fed at all?
So given that inflation's at headline CPI is at like 7%, I think when we're talking how many quarter point rate hikes we're talking about, that's obviously important for some types of some areas of the market. But overall, I think it's the increase in the balance sheet that in some ways matters more than the rate hikes, especially when we're talking that smaller of rate hike. And given how high debt levels are, they're somewhat constrained from raising rates too much too quickly. I think they can raise rates, but can they quote unquote normalize rates? Not anytime soon, I don't think. And so I think that the at least for asset valuations as a whole, the central bank balance sheet size is more informative. Now, as for the economy itself, as for inflation, supply chain issues, that's where I think the fiscal lever is the key thing, not the monetary expansion. And so, supply chains have two sides. They have supply and demand. And so part of the reason we have, these supply chain issues didn't come in a vacuum. Partially it was obviously COVID related, but a big chunk of it is the fact that we stimulated demand so much. And so we kind of chose between two options. We can either stimulate demand and run into these supply chain bottlenecks, or if we didn't stimulate demand, we'd be complaining about different things. We would be complaining about how there's just we wouldn't have the inflation we have now, but we'd have other problems. We'd have higher unemployment. We'd have other challenges to face. So kind of policymakers kind of found themselves in a corner. They chose the overstimulation approach, and so I think that as fiscal stimulus fades, that can impact the supply chains, right? So as some of those things get normalized and as the demand surge fades, that's where you look out for inflation. Now, there's still, we have to watch before the midterms to see if they do pass some aspect of the Build Back Better plan. I think that could be another bullish catalyst. Going back to the prior question of what could give the S&P 500 another kind of jolt upwards. I think that's one of the options. But as we go towards the end of the year, as we encounter midterms, that at least the current time look like they're going to be a more divided government. I think that overall fiscal is probably limited going forward compared to what we saw over the past 2 years, and that has tons of implications for inflation levels, for supply chain, tightness, and overall kind of demand for consumers. And then that can also feed back into the markets too, because as important as monetary stimulus was for markets, another thing was that a lot of retail investors were getting stimulus checks and then piling them into the market, and I think that's behind us now.
Lyn, I recently saw you share some charts on a post by Fed guy Joseph Wang about how quantitative tightening impacts the markets, and specifically how in the tightening in 2017, 2018, it was banks owned, they put their excess savings via repo because repos earned more than treasuries. Now repo yields less than treasuries, so they're buying treasuries. So that quantitative tightening could actually cause the banks to sell their bonds rather than buy more bonds, so that even though historically over the past 10 years quantitative tightening has been associated with flattening yield curves, long-term bond yields going down, people selling bonds, it actually could be the reverse this time. What do you make of that theory?
So I think it's a good theory. I think I categorize it less as a base case and more as a risk factor to watch. It's essentially, I think, one of the potential outcomes from a policy error. And so there's a lot of things that they can do to avoid that issue. They can change the SLR rules. The Treasury can change its debt issuance towards more bills. And so I don't think that's a foregone issue. But essentially, yeah, basically what he's pointing to is that if they do, say, very aggressive, not just say they stop expanding the balance sheet and inflation is still sticky because of the energy supply constraints, and say they want to start doing quantitative tightening, if they get overzealous on that, at the same time as the Treasury market is the Treasury Department, I should say, is not issuing enough bills, they're issuing a lot of coupons, and you could have a policy error that results in a kind of a Treasury market that goes illiquid and spikes, similar to what we saw in, say, the first quarter of 2020. And so I think that's something to watch, because that would probably be very bad for risk assets overall. And so it's something I'm watching around the margins. I think that the Treasury market has a couple different levers right now. So the growth deceleration that we're seeing in the Western world should put downward pressure on yields. On the other hand, the stickiness and the kind of the tightness of inflation in energy markets should be, obviously positive for them. And if you look at the absolute level, I mean, the long duration bonds are still well below the inflation rate. And so you'd think that their natural tendency would want to go up to some degree. Now, my base case is that most of the 2020s, they'll be submerged below the inflation rate. And so in some ways, my view is towards generally higher inflation and generally lower yields. And I think that's the regime that we're in, but a lot of things can change for periods of time around the margin. And so there are periods of time where I will join my friends over in the disinflation camp, and say, I think that we're, as sticky as I think inflation is, I think we could be peaking in rate of change terms year over year, for example. And there could be other periods of time where I think, that the long duration yield are overdone and that we're due for maybe a flattening of the curve. And so the way I interpret his information is that it's something to monitor. It definitely, it basically gave me some charts to watch to observe problems in a similar way that I mean, I think Luke Groman did excellent analysis back in 2019 that pointed towards some of the supply demand mismatch between T-bills and cash, and that culminated in the repo rate spike. I think he had one of the best calls of that year, and it kind of pointed towards areas to watch. And so I interpret the data the same way.
I was just thinking of Luke Roman's point because about the negative real rates. Why do you think that the bond yields, bill yields, note yields, all sort of fixed government assets will yield substantially lower than inflation, and that the yields won't rise in order to meet inflation like they tried to do during the 1970s? What are the structural reasons for that? You allude a lot to the 1940s, but of course that was the federal government and the Fed enacting yield curve control, really capping yields. Is that part of your base case? And also, do you think we're anywhere close to there now?
So I think the main reason is, so if you look at the 70s when you had high inflation, the Fed was able to raise rates super high because debt as a percentage of GDP was very low. And so Volcker could raise rates to double digit to try to combat inflation. The problem now is that debt levels are so high, including public debts, that if you were to raise rates, to levels that exceed inflation and hold them there for a long period of time, you would have absolutely massive fiscal deficits because you'd have this kind of fiscal, spiral where your debt, your payments on the interest are so high relative to your tax revenue and relative to the size of your GDP. And so the last time we found themselves in that environment was the 40s, which is where even though you had periods of high inflation, they had to hold rates low anyway. Now, some people, I think, overstate that, so they go and say, oh, the Fed can never normalize, they can never raise rates, and that's not the case either. I mean, it's not like, around the margins, 1% interest rates, changes are not going to really affect that too much. I'm basically saying that they can't normalize back up to 2, 3, 4, 5%, kind of rates and hold them there for very long periods of time, or and have these kind of structurally positive real yields is what I'm saying, over long stretches. And so we've seen some of the kind of the plumbing changes under the surface. So there's been kind of different, regulations to basically increase appetite for treasuries. And so I think that overall we're kind of in a period of financial oppression that I think is more sophisticated than the 40s. So in the 40s, it was kind of this ham-fisted yield curve control approach. And I think now that yield curve control is kind of a backup option that they can resort to in a crisis. But I think that they are trying to engineer a much kind of a smoother way of doing that, of basically mandating large pools of capital to have large amounts of treasuries, and then also creating, shortages by buying a lot of them off the market and basically avoiding, having too much excess supply relative to the market's demand for it. In addition, if you have, it's one of those things where if equity valuations are reasonable, people should obviously pile into those rather than treasuries. But at a certain valuation level, if you're concerned about, say, broad indices not doing very well over a 5-year stretch, then their risk reward can look as bad as bonds in some cases. And so some investors will be willing to hold bonds even if they expect to lose purchasing power, because they'd rather lose purchasing power in a less volatile way than if they expect to lose purchasing power with equities. And so I think there will be stretches of time where market participants, probably rightly, view bonds as a better alternative to some of the stocks out there. Now, I think if you have a very long-term approach, I think that there are other options. I think value stocks have better value proposition than bonds, for example. You can get a higher yield, you can get more growth out of them in exchange for more volatility. And so I think that overall that's something to watch. That basically that the combination of equities being so expensive, growth equities, and these different changes to market structure, basically helps kind of keep yields below the inflation rate.
Mm. So yeah, when you say the more sophisticated mechanisms of suppressing rates by, you're saying buying, taking them off the market, the mortgage-backed securities, the treasuries, that's QE, expansion of the balance sheet. And then the regulation stuff, I associate that a lot with Dodd-Frank, requiring banks to have a lot of this safe capital. Lyn, if I had to ask you to rank each decade by how good it is or how bad it is to own bonds, how would you rank the 1940s, the 1970s, and the next 10 years?
So there's qualitative differences rather than just ranking differences. And so, for example, in the 1940s, it was better to own bonds than bills, because when the whole yield curve is pegged, it was pegged at a positive rate. And so it was actually, if the long duration bonds are yielding 2.5%, which is what they were, and the short duration stuff was yielding near zero, the market started to figure out that if the long duration bond's pegged, they could just pile into the long bond, and they still lose purchasing power, but they lose less purchasing power than if they own bills. Basically, if inflation's running at 6%, would you rather earn 2.5% or 0%? 2.5%. Now the 70s were the opposite, because you had rising rates, and so it was actually much better to own T-bills than the T-bonds. And so I think that the 2020s probably, more closely mirror the 40s in that regard, where that's partially what keeps a bid on the long bond, is because if you have, the whole yield curve is submerged below the inflation rate for long stretches of time, but the yield curve is still, spends most of the time being positive, except maybe right before a recession, um, then overall you end up benefiting from owning the long end of the curve. And so it's not a trade I like. I like the equity markets better. I like the commodity markets better. I like Bitcoin better. There are many other assets I'd like to go to. But overall, I think in purchasing power terms, I think the 2020s are, maybe not as bad as the 40s and the 70s. I think there's too many factors to judge, but I think we're up there in terms of bad decades for bonds. So the 2010s were already a bad decade for bills. I mean, if you held bills, you lost purchasing power during the entire 2010s decade. There were very brief windows where your yield was higher than the headline CPI. And so I think that's going to be the case for the 2020s as well. And I think now that, with higher average inflation for the 2020s and the 2010s, in my view, while bond yields still stay pretty low, I think most bonds will probably underperform inflation in the 2020s decade.
Mm. You mentioned Bitcoin obviously had a huge bull run the past 2 years, has hit some headwinds over the past 2 months. What is your outlook both on the technological, let's say the non-macro side, as well as on the macro side? I think Bitcoin actually likes inflation. It likes rising inflation expectations. It doesn't mind rising bond yields on the long term, on the long end. So all of that is good for Bitcoin. However, you do have the massive potential of the Fed tightening liquidity, taking the punch bowl away, and specifically raising rates and quantitative tightening. How are you weighing the risk and rewards at this stage?
So I'm intermediate term neutral on Bitcoin. Long term, I'm still bullish fundamentally. And the way I would characterize that is, basically in this kind of period of where the Fed is trying to pull back the punch, but where there's less stimulus, where money supply is growing slower than it was, now than it was over the past couple years. That is somewhat of a headwind for Bitcoin, especially because NYDIG put out a good chart the other day showing that, from 2011 to 2019, Bitcoin didn't have very strong equity, positive equity correlation. Sometimes it was positively correlated, sometimes it was negatively correlated. It was kind of so small that it was its own thing. Now, it tends to like higher liquidity environments, but overall, there wasn't very strong correlation. Ever since 2020, it's had very positive correlation, and I think partially that's because institutions became a big part of the market, and two, because with so much stimulus, almost everything was correlated positively. So anything other than, like, say, cash and gold, most things went up a lot, over the past couple years, and so I think going forward, I think these correlations are somewhat heavy on Bitcoin. But I think that, when you have something that is fundamentally better than something else, eventually that correlation breaks down, and you can start kind of grinding higher. And so, one thing I would point to is that, for example, let's say ARK, for example, or, as a proxy for unprofitable growth stocks. They peaked in February 2021, and they've had this very weak period. Bitcoin didn't peak in 2021, but it did peak around that springtime. Then it went down quite a bit. Then it had a rally, and actually it very slightly touched new all-time highs. But anyone looking at the chart can see it's been in this consolidation ever since the first quarter of 2021. And so the way I would describe it is that it's separating in terms of magnitude rather than direction. So it's kind of correlating with the ARK basket in the sense that both of them had very rough years. But whereas ARK, is down, something like 50%, it's continually hit lower lows, whereas Bitcoin has instead kind of consolidated sideways. And so I think that's something to watch for a high quality asset where, it holds up better than weaker things when it's having a rough time, and that sets up the foundation for another run, I think, when the macro conditions improve. We see over this time that, during the 2020 period and going into 2022, so there's not a lot of new demand for Bitcoin. That's basically what's been taken off the market by the lack of stimulus, that the new demand coming in is not as high as it was back in 2020 and then the very early phase of 2021. However, the supply side is interesting because a lot of the weak hands have sold out. A lot of the coins have shifted more towards the illiquid strong hands that have a low propensity to sell. And so a lot of indicators suggest that basically whenever demand does come back into the market, it's kind of like a cold spring. And so that's how I'd phrase it overall, that the conditions are good, but it needs a spark. And so I don't see a spark, anywhere super close right now. So that's why I'm kind of neutral in the intermediate term. I'm just kind of watching the market for catalysts. But I think longer term is still very attractive. I also think that Taproot, it got a lot of attention. The upgrade to Bitcoin in late 2021 got a lot of attention when it happened, and now it's kind of died off. But I think that's going to have very positive implications for the Bitcoin network in terms of technology. I think it greatly improves the Lightning Network that I'm bullish on long term. And so I think that basically, while the price is consolidating sideways, all the developers are still working on Bitcoin, building out the rails, building out Bitcoin as both a payment network and an asset. And so I think that's all continuing to grow and get stronger.
Mm. Yeah, and I also just note about the macro, which is that the huge epic bull run up for Bitcoin in 2016 and 2017 happened while the Fed was raising rates. So it's not a purely macro asset like a lot of things. I also so your a neutral outlook in the medium term, long term, you're still bullish. How are you weighing, discounting, estimating the likelihood of a serious correction that we saw in 2018, somewhere around the 70% or 80% correction? Obviously, that's always possible for any asset. But are you saying that is small, negligible, moderate, something that people should think about, something that people should have a plan for, or is it not really on your radar?
I would say moderate, and I think it's partially related to what happens in energy and what happens to policymakers. So basically, it's partially, you're kind of estimating human decisions, and therefore it's hard to put a percentage on it. And that's why I like to say that I don't know if the market's going to go sideways. I don't know if it's going to have this kind of big kind of a sharp correction. That partially depends on decisions that I can't forecast. But I think we're in a window we are at risk for a much wider variety of sideways to downward moves that I think risk managers have to be aware of. And so I think that that's why, having some cash or bond exposure is not a bad idea in this environment because you can rebalance into your preferred assets. I also think that more defensive value, higher yielding type of assets are somewhat of a safe haven, at least relatively speaking, in that kind of environment. I think they can hold their own. If you look at, that sell-off that happened in quarter four 2018, um, you know, basically a lot of that was concentrated in the growth stocks. Right? So Apple was off well over 30%. The SPF 100 was down 20% roughly. Generally the more defensive value things held up pretty well, and even actually emerging markets held up reasonably well in that sell-off. People often assume that they have to go down more than the S&P 500 in a sell-off, and that's not necessarily the case, depending on what's causing that sell-off. And so I think that there are areas that you can reduce your volatility by having exposure to. I think we have to also keep watching gold because, as I pointed out, the fact that it's held up pretty well, even in this kind of sharp upward move in nominal and real yields, has been interesting. And so if you start to see confirmation, if you start to see higher highs, out of this kind of sideways consolidation in gold, I think that's one of the risk management tools that portfolio managers can use, either with the gold equities or gold itself. I think that's something to keep on their radar that could help them maybe reduce the severity of a down move. Because obviously, if you have a move that's kind of illiquid, then everything gets punished, right? But if you have kind of a slower grinding type of downtrend, gold can often do pretty well in that environment. So I think it's something to keep watching.
What asset are you most constructive on for 2022, and why? It can be a sector, it can be a single stock, it can be an asset class.
So I would say, I think that some of the, even though the energy area might be overdone in terms of enthusiasm, the pipelines, many of them are still below their price level that they were going into the pandemic. They're less concerned with price and more concerned about volumes. And so I think, a lot of them yield 6-7% or more And so even if they go sideways for another year, I think that that could do very well compared to the market if the market goes sideways and pays a lower yield. And so I do like some of the higher quality energy pipeline companies. Um, I also still like some of the healthcare companies. Either diversified pharmaceuticals or some of the insurance companies. I think those are reasonably attractive in this environment. One of the catalysts there is that there was a lot of impending regulation that might have suppressed some of their pricing power, and that's kind of in doubt right now based on what's happening in Congress. And then after 2022 midterms, that could be further de-risked. And so the market started to price in kind of a more mild kind of legislation move against them, and now that might does not have any legislative move against them. So it remains to be seen. But I think that there are areas like that are pretty attractive.
How are you thinking about banks? Banks obviously do well when yield curves are steep, when rates all across the curve are high. We just a few days ago had JP Morgan, Goldman Sachs report earnings. Market didn't like that too much. It seems like the music is slowing when it comes to investment banking revenue and that sort of stuff. But we had Bank of America report today. It seems like consumer lending we could be at the beginning of a credit cycle. So how are you thinking about the financials? You mentioned insurance, that's related, whether it's the investment banks or the sort of brick and mortar banks like Bank of America.
So I'm neutral on them. I think that they because they generally pay decent dividends because they're able to buy back shares with all their profitability. I think that could give them some support in what could otherwise be maybe not the best market environment. On the other hand, the fact that I'm kind of temporarily going over, with my deflationary friends and saying that, because we have slowing growth and because we could have this kind of year-over-year peaking in headline CPI, that's not necessarily great for the yield curve. And so I'm not kind of pounding the table on bank stocks, but I'm also not kind of running for the hills from bank stocks. It's not one of my high conviction areas at the current time. It's obviously it's part of the more cyclical value camp, and so for me, I'm kind of neutral on those. I would say that if I was long, I am long banks, but one way to hedge, I think, long-term risk with that is to own Bitcoin, right? So for me, it's not any one asset. It's I like energy pipelines, I like healthcare companies, I like Bitcoin. I like some of the banks. And then even with technology, there are still ones that I get into. I'm just more selective and very cautious with my valuation and growth assumptions there.
Yeah, I know when it comes to non-US stocks, you're very active, and often your analysis is more about the micro than the macro. But how are you thinking about emerging markets as well as Europe, China, India, and how do you think that these sort of equities will perform?
So I'm moderately bullish on emerging markets as the world kind of moves past Omicron. It's not all at the same time. And so, for example, India is still in their upswing in terms of Omicron. But as the world moves past Omicron, I think that's probably constructive for global growth. We also see that China is on a different timing sequence than the rest of the world. So most countries have their PMI rolling over. China's has already been weak. Their credit impulse is rolling up, if anything, early signs. And so that could benefit either Chinese equities, maybe outside the real estate sector, because I don't particularly want to touch the real estate sector. Yeah. But it also can buoy the rest of emerging markets. And so sentiment on Brazil's been very poor. I think we're seeing initial signs of that market trying to bottom. So I think investors should have Brazil on their radar. And so I think that broad emerging markets, if you get that weaker dollar environment, which is not guaranteed, but I think there are some catalysts in place that could, either weaken the dollar or at least maybe prevent it from strengthening too much. I think that's kind of an interesting play there. So while I'm not necessarily pounding the table on emerging markets, I do think that their stretch of underperformance might be behind them, and that they do offer some better valuations, some better growth, and that overall I think that they're at least a place that investors can look through. I'm rather, I'd say I'm moderately constructive on emerging markets.
Okay, now the reverse. What asset are you the least constructive on, the most bearish on for 2022? Is it the mega cap growth? Apple, I know, is not exactly a favorite of yours, or is it ARK, the speculative growth stocks, or is that sell off overdone? Is it bonds? How are you sort of thinking about the thing you're most bearish about?
So I'm concerned with some of the mega cap growth, and I think Apple's an interesting one because I mean, if you look at their analysts are expecting single digit growth over the next couple of years. So it kind of has it's like a value stock trading at growth stock valuations, and it's the largest stock in the index. And so when I look at mega cap growth, I kind of separate out the different companies. So for example, I'm not as bearish on Amazon as I am at Apple at the current snapshot in time, for example. So I am concerned about some of those, Apple, Costco, maybe Nike, Nvidia, some of these kind of very large cap growth equities that I think have gotten ahead of themselves in terms of valuation. Um, and again, you could still even go up, and just I think it goes up less than it has been before, or you could go down quite a bit. And so it's not necessarily a call on direction, more just like a call on I don't like the risk reward ratios of owning a lot of those mega cap growth stocks. Other than maybe on a selective basis, if there's, if one already consolidated for 12 to 18 months, like maybe Amazon has, I'm less concerned about that one than maybe some of the others. That might or may not be right. So the ARK stocks, they've sold off so aggressively that if anything, they're actually there's some that I'm kind of watching for bottoming opportunities. Um, you know, earlier in 2021, Kathy Wood was appearing on magazine covers. Everyone was kind of super bullish on ARK. I was concerned about valuations. When that started to roll over, I kind of got in a little bit too early. And there are a couple growth stocks in there that I picked through and I liked. But I think the more that whole sector capitulates and people kind of make fun of ARK, that's actually when I want to start looking at some of their companies. So I actually do have some of those on my radar for potential bottoming opportunities, going forward. So I think my biggest area of concern is probably at least a subset of the mega cap growth stocks.
And Lyn, right now we're in the thick of earnings seasons reporting Q4 2021 earnings. How are you thinking about the next year of earnings? 2020 obviously saw earnings take a huge hit due to the first COVID shock. However, multiples skyrocketed, so stocks actually went up. 2021, contrary to what some people think, earnings went up, and they went up so much that multiples actually contracted. So stocks became less expensive, if you can put it that way. How are you thinking 2022 will be? Will earnings be above expectations, right there in the middle? And then what do you think was going to happen to the multiples?
So I'm expecting probably somewhere in the middle. It's not a super high conviction, but I think that the spread of positive surprises is probably behind us. And so whether or not we're mildly above expectations or mildly below expectations, that obviously depends on a lot of factors. But I do think that in rate of change terms, the spread, we're going to be less surprising to the upside than we had before. And so I think that, should give us pause again around some of the broad indices. So again, when you have kind of declining PMIs, when you have these other kind of risk-off factors that are kind of, flashing their warning signals, I'm not super bullish on some of the earnings outcomes, even though I think that, again, some of the sectors could continue to surprise me to the upside, and that, they're priced in such a way that I'm willing to go through some of that choppiness for some of the say the growth at a reasonable price companies, the high quality value stocks, the good dividend pairs. I'm willing to kind of go through any sort of choppiness that they have.
Okay, Lyn, we've got some great questions from Twitter, if you don't mind me asking. You mentioned Brazil. Someone said, I think Brazilian stocks are very cheap. Can you ask Lyn what she thinks of Vale or PBR, PBR being Petrobras? So these stocks in Brazil that are trading with a PE of something around 3 and offer 18 and 8% dividends respectively. How far into the value cookie jar are you sort of willing to go? Because you can buy shipping stocks that have a forward PE of 1.5,
I think you can certainly go into those. You have to manage your position sizes differently than if you're buying maybe a more sturdy value stock that's maybe not quite the returns you can get if you're right on the Brazilian equities, but they also have less tail risk. And so Brazil would benefit significantly from a weaker dollar, from a more persistent, kind of higher commodity environment. And so I do think that I'm rather constructive on Brazilian equities. I do think we have to look for, potentially what we're seeing as a bottoming opportunity in their headline indices, at least price in dollar terms. Like if you look at the EWZ ETF, the Brazil MS, the iShares MSCI Brazil ETF. I think you have to look for potential bottoming there. There are obviously risks to that outlook. There are kind of government risks there. There are a lot of challenges. But I do like it overall. I do like Brazil.
All right, we've got two questions about two other regions. Egypt, I know you were there about a year ago, and you were very interested in investment opportunities in Egypt. And then also Russia, which you have been constructive on, one of the greatest natural gas producers in the world, no doubt. But they're having some serious political issues with the U.S. and Ukraine. So how are you thinking about Egypt and then Russia?
So I've been meaning to write an article on Egypt. I have family and friends there. I travel there regularly. Um, in general, the challenge there is that they do have a structural trade deficit, and so I am concerned about some of their currency fundamentals. I do like their real estate market. Their real estate market is actually one of the cheapest in the world. Part of that's because they're building so much, so you don't really have a lot of supply constraints. But it is an interesting real estate market overall. So I tend to like their that market. Again, if you get a weaker dollar, that's one of the ones you could see a big upward move because you have very low valuations, but you do have some of the currency challenges. So they, about 5 years ago, they broke their currency peg, and basically their currency got cut in half overnight. So if you just had your savings in Egyptian pounds, you just lost half your purchasing power. But since then, they've been very steady. And so it's not like they're one of the ones like Turkey that just keeps grinding down. It's like they're holding very steady. And my concern is about these stepwise changes that can happen. And so it's one of those things where I view them as quite risky, but that there's opportunities there if you look through them. For Russia, fundamentally, I've been pretty bullish on Russia. Into the autumn of last year, that was playing out very well. It was one of the stronger indices, especially when you include the dividends. It was doing very well. Obviously, the Ukraine situation has thrown a big curveball into that. I would say that this is either an epic buying opportunity or the start of something worse, and that really depends again on mapping out human decisions. So I would say that I am bullish on Russian equities with the caveat that you need to manage your position size cautiously to avoid tail risks. And so if you look at their valuations, they're attractive. They've also positioned themselves so that, say, unlike Egypt, their trade and current account situation's great. Their debt is great. They have very high reserves, so they've made themselves rather sanction resistant overall. They've kind of Russia's kind of got that fortress balance sheet aspect to it, but that can take years to play out. And I think the biggest risk for me, I'm actually less concerned about the performance of Russian equities, and I think the biggest tail risk is that if Americans are, say, barred from owning Russian equities. So it's kind of a different type of risk that we normally associate with markets.
Fascinating. Well, Lyn, thank you so much for joining us. As you recover from this virus, I really appreciate your being here. Your writings can be found at lynalden.com. I'm an avid reader of that, and I really recommend our viewers check that out. And your Twitter, you can be found on Twitter at Lyn Alden Contact. Lyn, thank you so much. Hope to have you back soon.
Thank you. Thanks for having me.